Right now, you can trade Tesla stock without owning any Tesla stock. You can do it at 3 in the morning on a Sunday using money you don't have, and the platform letting you do this doesn't need to own a single share of Tesla. This is not a glitch. This is the system working exactly as designed. What you are trading is not Tesla. It is a contract that tries to follow Tesla's price. It feels like ownership, but it works nothing like ownership. And the gap between what people think they are buying and what they are actually buying is getting wider every day. That gap is why this case file is open. The story most people hear goes like this. Derivatives are old. They have been around for hundreds of years. Farmers use them to lock in prices for crops. Airlines use them to protect against fuel costs going up. Big companies use them to manage risk. This is normal. This is useful. And now the story continues. Crypto platforms are just doing the same thing. They are giving people new ways to get exposure to assets they want. Binance lets you trade a Tesla equity, perpetual contract. Chainlink is building a blockchain Oracle network, so developers can make products that track stock prices. BitMEX offers equity perpetuals that never expire. The builders say they are adding better tools. They say they are improving how liquidation works. They say they are giving people access to an $80 trillion stock market. That is the official story. But this story skips over one thing. When you buy a stock, you own a piece of a company. When you buy a perpetual futures contract that tracks a stock, you own a promise. And promises work differently when things go wrong. Before we go further, you need to see the fingerprint of this pattern. It has shown up before, in the years before 2008. Banks created something called a synthetic CDO. A synthetic CDO did not hold real mortgages, it held bets on whether mortgages would be paid. The Financial Crisis Inquiry Commission found that one mortgage bond could be referenced by more than $50 million in synthetic bets. The exposure was far bigger than the real thing underneath it. This is not the same product, but the shape is the same. Build a layer that references a real asset. Make it tradable. Make it scalable. Let people treat it like the real thing. Then see what happens when the tracking breaks. The pattern is not about one type of product. It is about what happens when exposure grows faster than the rails that make exposure behave like ownership. The moment most people miss is not a crisis, it is a decision made quietly in product announcements and blog posts. On January 20, 2026, Chainlink launched what they call 24/5 US Equities Streams. This blockchain oracle feeds stock price data onto more than 40 blockchains. The service covers major US equities and ETFs, including names like Tesla, Apple, Nvidia, and index ETFs like SPY and QQQ. The company said this unlocks the $80 trillion US stock market for decentralized finance. 8 days later, on January 28, 2026, Binance launched a Tesla perpetual futures contract. It tracks the price of Tesla stock. It settles in a stablecoin called USDT. It offers up to 5 times leverage. You can trade it 24 hours a day, 7 days a week. You will never own a single share. Around the same time, the New York Stock Exchange announced it is building a platform for tokenized stocks that could also trade around the clock. Nasdaq is exploring similar 23-hour, 5-day-a-week trading infrastructure. Robinhood launched tokenized equities in Europe, offering over 200 US stocks. The DTCC, which handles clearing for most US securities, is working with Chainlink on settlement infrastructure. These are not accidents. They are infrastructure being built at the same time from different directions toward the same outcome. A world where exposure to stocks can be created, traded, and settled without the stocks themselves moving. This is what the industry calls real-world asset tokenization, or RWA. It is the convergence of traditional finance and decentralized finance. And the question is not whether this is happening, it is what happens next. Here is what most people miss about what they are actually buying. When you buy a Tesla share, you become a shareholder, you can vote, you get dividends. If the company pays them, you are inside the system of corporate ownership. If Tesla goes up, you benefit. If Tesla goes bankrupt, you lose money, but you have real legal claims. When you buy a Tesla perpetual on Binance, none of that applies. A post on Binance Square said it clearly. The trader is merely betting on price movements. There are no dividends. There are no voting rights. This is not a secret, but it is easy to miss. A person opens an app. They see TSLA on the screen. They think they are trading Tesla. They are not. They are trading a contract that tries to track Tesla. The difference between those two things becomes real when something goes wrong. Now look at how perpetual futures actually work. A perpetual futures contract has no expiration date. Unlike normal futures that settle on a specific day, perpetuals can be held forever. The trick is something called the funding rate mechanism. Funding rates are periodic payments between long and short traders that keep perpetual prices aligned with spot prices. When the perpetual trades above the spot price, long traders pay short traders. When it trades below, the payment goes the other way. This funding rate mechanism is what makes perpetuals track the underlying asset, but it is not perfect tracking. It is approximate tracking with periodic corrections. A perpetual futures contract also uses margin. You put down a small amount, the platform lets you control a larger position. If you use 5 times leverage, a 20% move against you wipes out your entire margin. When your margin falls below a certain level, the platform closes your position. This is called liquidation. You do not get to decide. The platform decides. If the market moves fast, you can lose everything you put in before you even know what happened. Chainalysis, a company that studies crypto markets, said traders face liquidation risk during periods of market volatility. BitMEX, which invented crypto perpetuals, has said equity perps give synthetic leveraged exposure to equities. The word synthetic matters. It means you are not holding the real thing. Investopedia defines basis risk as the risk that a hedge or proxy instrument does not move perfectly with the underlying asset. The synthetic product is supposed to track the stock, but tracking is never perfect. When markets are calm, small gaps between the synthetic price and the stock price look like noise. When markets are stressed, those gaps can become liquidation triggers. So the user might look at Tesla and think the stock should recover, but their position on the perpetual has already been closed. The market did not care what Tesla might do tomorrow. The margin system cared about what the contract did today. There is another layer to this. The Tesla perpetual on Binance settles in USDT. USDT is a stablecoin. It is supposed to be worth $1. That stablecoins have depegged before. In October 2018, USDT dropped to 90 cents. In March 2023, USDC dropped to 87 cents because of its exposure to Silicon Valley Bank. Kraken, a crypto exchange, published information explaining that many crypto futures contracts are collateralized using stablecoins. If a stablecoin depegs, it can contribute to liquidations, especially for traders with thin buffers. This does not mean OSDT will depeg. It means the risk stack is taller than most people realize. There is Tesla price risk. There is leverage risk. There is platform risk. There is funding rate risk. And there is the stability of the money being used to settle the trade. Each layer works most of the time, but under stress, each layer can break in ways that multiply the others. The platforms that offer these products make money when people trade. They do not make money when people hold stocks for years. They make money from activities. A perpetual futures contract is a good product for activity. It has no expiration date. People can hold it forever, paying funding rates along the way. They can use leverage. They can trade at any hour. More assets, more leverage, more hours means more fee, surface area. The user gets the feeling of having exposure. The platform gets paid, whether the underlying asset moves or not. The user takes the liquidation risk, the basis risk, the counterparty risk, the collateral risk. The platform has rules that protect itself from those same risks. This is not a scam. The incentives are simply aligned in a way where expansion is easier than restraint. The regulatory picture is still forming. In the United States, the CFTC, which stands for the Commodity Futures Trading Commission, has jurisdiction over commodity derivatives. The CFTC has generally viewed perpetual futures as swaps, which are specialized derivatives that can only be traded by sophisticated participants. This has kept perpetuals out of reach for most US retail traders. But platforms operate globally. Binance serves users in many countries. Exchanges based offshore can offer perpetuals to users that US-based platforms cannot. And as real-world asset tokenization grows, regulators in Europe, Asia, and elsewhere are creating their own frameworks. The SEC and CFTC held a joint roundtable on tokenization. The SEC has signaled it may issue rules for tokenized securities, but for now, much of this activity happens outside clear regulatory boundaries. Systems drift when incentives point one direction and nobody pushes back. Step 1, a new product is called innovation. Step 2, it grows because it is easy to use. Step 3, liquidity concentrates inside the synthetic product. Step 4, the synthetic market starts to feel like the real market to its users. Not because it is real, because it is always there. People get used to exposure. That is not ownership. They get used to trading something that references a stock. While the stock market is closed, they accept liquidation as a normal feature instead of a warning. And over time, this changes behavior. More leverage becomes acceptable because the product is liquid. More retail users enter because the product looks simple, but the risk stack is not simple. Here is what to watch for. These are the signals that show where this goes next. If more exchanges list equity perpetuals, it means the exposure business is expanding beyond crypto-native assets. Binance started with Tesla, more will follow. If platforms emphasize liquidation logic and Oracle integrity, it means builders know off-hours trading creates special failure modes. Chainlink has already said their blockchain Oracle streams enable enhanced liquidation logic and risk management. If you see dislocations between synthetic prices and underlying prices, it means basis risk is becoming visible. This happens when the synthetic product moves in ways the stock cannot support at that time. If large liquidation events happen around equity-linked perpetuals, it means margin mechanics are driving outcomes more than the company itself. If traders migrate to always-on cross-asset platforms, it means demand for synthetic exposure is rising. If the CFTC or other regulators take action against perpetual futures platforms, it means the activity has grown large enough to draw official attention. And if stablecoin stress gets mentioned alongside margin futures, it means the collateral layer is being recognized as part of the risk stack. The tokenized equity market, also called the RWA equity sector, grew from $32 million at the start of 2025 to over $900 million by January 2026. That is a gain of nearly 2,800% in 12 months. The New York Stock Exchange is building a platform for 24/7 trading of tokenized stocks and ETFs. Nasdaq is exploring similar infrastructure. Robinhood launched tokenized equities in Europe. Chainlink is providing the Oracle data. Binance is providing the perpetuals. The DTCC is working on tokenized collateral systems. The infrastructure is not being built to slow things down. It is being built to speed things up. This case is not about whether a Tesla perpetual exists. It clearly exists. The question is, how much synthetic exposure can build before tracking assumptions become stress events? The builders say they are adding better controls. They say synthetic exposure can be a legitimate tool, and they are not wrong. Derivatives have legitimate uses. They have always had legitimate uses, but legitimacy and stability are not the same thing. The Financial Crisis Inquiry Commission said synthetic CDOs multiplied exposure to the subprime mortgage market without multiplying the actual mortgages. That was not illegal, it was structural. The same structural habit is present here. Build a layer that references a real asset. Make it tradable, make it scalable. Let participants treat it like the real thing. This file remains open because the core test is still running. If tracking remains stable across volatility, if dislocations stay contained, if users understand what they are buying, the concern gets smaller. If liquidation cascades happen during stress, if platform failures take down user funds, if the gap between what people think they bought and what they actually bought becomes a public problem, the concern gets larger. The system is not hiding what it is doing. The announcements are public. The product pages explain the mechanics. The risk disclosures are there for anyone who reads them. But the emotional experience of the product is different from the legal reality of the product. People see TSLA and think Tesla. They do not think margin requirements, liquidation engines, funding rate payments, stablecoin settlement, and basis risk. That gap is the case. In 2008, synthetic exposure grew faster than the real assets underneath. The layers multiplied, the exposure spread, and when tracking broke, the system did not have enough underlying assets to absorb the losses. This is not 2008. The products are different, the markets are different, the regulations are different, but the shape is familiar. Exposure expanding, rails not keeping up, users assuming the synthetic version behaves like the real version. The people building this infrastructure believe they are expanding access, they believe they are democratizing markets, they believe better Oracle data and faster execution will make everything work. They may be right, but the reason this file stays open is simpler than any of that. When exposure grows faster than ownership rails, the gap between what people think they have and what they actually have gets wider. And that gap only becomes visible when something breaks. The only question is, what breaks first?